Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Oracle falls after reporting a jump in end spending on AI data centers and other equipment. We're going to discuss the impact, and there is impact, on the broader tech sector.
Plus, Disney agrees to invest $1 billion in OpenAI and license characters for use on the Sora generative video platform.
And more tech earnings with chip design software maker Synopsys. Our conversation with the CEO later this hour.
Meanwhile, we turn to some breaking news, and it's geopolitical in nature at the moment. So, Ed, we are looking more broadly at the Ukrainian president, Volodymyr Zelensky, floating the prospect of putting the issue of territorial control in a peace deal to a referendum. Now, this comes as Kyiv comes under mounting pressure to agree to terms to end Russia's war. Moscow has insisted that Ukraine withdraw its forces from the eastern Donbas region, which the Russian military has failed to capture in its nearly 4-year invasion. So much to be digesting on geopolitical news today, on macroeconomic news after the Fed yesterday, and of course on AI anxiety that hits this market hard. More broadly on the Nasdaq, we're off by a percentage point, Ed. And I'm afraid, step aside, Jay Powell, the focus is all on Larry Ellison and what is happening at Oracle and how much money is being deployed in the build-out of infrastructure, Ed.
The anxiety is coming from Oracle. This is a 2-day chart to make a visual representation of the point. It's a big drop. Right now, on track, if it closes at this level of decline, its biggest drop in 24 years, going back to 2001. Very simply, capital expenditures, several $billion beyond what the street thought they would be in the quarter. Cloud growth, we're talking cloud growth way up there, particularly in the infrastructure unit, but just shy of very high expectations. Interesting right now, if you look at the chip space, Nvidia, also like Broadcom, big declines. And at the index level that you were just showing us, Caroline, those names are part of the drag. So we need to dig into what's going on. Yeah,
and we've got Broadcom numbers after the bell as well. Let's focus in on Oracle. Bloomberg's Brody Ford has been covering this story, and we knew that they were spending an awful lot on capital expenditure, but $50 billion and not enough in terms of the revenue to show for it.
Yeah, AI anxiety is right. I mean, the big question for Oracle and all of its peers right now is building AI infrastructure a good business to be in? Wall Street understands it takes a lot of upfront costs, but it seems like every single quarter it's more than we thought it would be, and the revenue recognition is further out than we thought it would be. And so Oracle kind of gave the exact message that Wall Street wasn't hoping for, which is we're spending more, and it's taking a little longer than you expected to see the revenue uplift.
But it's a trade-off with growth. So I'm just going to go through some of the numbers, right? The street thought that capital expenditures in the quarter would be about $8 billion. They ended up being $12 billion. But overall cloud growth, get into that, and then infrastructure growth, like that is growth. It's just that it's basically in line with consensus. What more is it that the street wants?
Yes, it's big growth, but the question is it empty calories, right? I mean, what is it? The first question on the earnings call last night was, please tell us how much it's going to cost to put up these data centers. Give us a total number. It was a level of, I'd say aggression that you don't typically hear on an earnings call because it's just still not clear. I mean, no one's put up gigawatt scale data centers before, 5 of them at once. There's a lot of questions about when Oracle is putting up these big data centers for OpenAI or Meta or Nvidia, what is the true cost profile? And the jury is just still out.
The jury is out, and also the questions are abound of their overall exposure to one key player.
Yes.
$300 billion is how much OpenAI is saying they will invest via Oracle. But when are we going to see that? When is Oracle actually going to be able to book that as real revenue?
Right. A lot of us remember in September when Oracle stock went gangbusters and they were the favorite child of the market for a couple days. But since then, what's happened is OpenAI has made a bunch of commitments with really big billions numbers with a lot of other vendors. And it's made the market say, wait a second, can OAI really pay all of these bills? And so that concentration risk on OpenAI is a key one for Oracle, and one the company has tried to push away by saying, look at the big deals we've had with Meta or Nvidia or others.
Bloomberg's Brady Ford with
Thank
the
you.
reporting. Thank you very much. Let's get more with Alex Zukin, Managing Director, Senior Analyst, covering enterprise software at Wolf Research. The price target, $275 on this stock, trading at 192.82. Okay, we accept there's some anxiety. They are spending more than you lot thought they would. They have some growth. Where in the equation are they sitting for you?
Yeah, I think right now it's a timing mismatch. I think they're getting overly penalized for a number of elements. I think there's kind of a vote of no confidence from this market around the ability to grow and serve OpenAI, both on the OpenAI front, quite frankly, and the Oracle front. And I think that's a mistake. We truly believe that compute demand at the moment is insatiable. It's not just insatiable for OpenAI. It's insatiable for other foundation model companies. It's also insatiable for other hyperscalers. I think even on the Microsoft call, they noted how much more demand that they had in the quarter for Azure that they couldn't supply. So we're pretty confident that the demand is real, that the demand is there. And we continue to see accelerating growth with the company stating pretty clearly they, A, expect to maintain investment grade credit, B, they don't believe they will need to spend more than, and quite possibly significantly less than $100 billion in debt. And on OpenAI, A, they believe they're very much good for it, but that the demand is truly fungible. And if OpenAI can't make those commitments,
Alex,
there are a lot of other...
No, I appreciate that. Negative free cash flows, 10 billion, right? And the debt pile you point out has hit $106 billion in debt. This chart is Oracle 5-year CDS. Oracle CDS at the highest level since 2009. Credit default swaps, the cost of protecting debt against default. It's a chart, but it's a reaction. And the 3 points you just made, clearly, there's a large portion of the market that doesn't share that viewpoint with you.
Yeah, look, I think the CDS chart, I think it was important for Oracle to state that they expect to maintain investment grade credit worthiness. I think that there's also a number of flexible options that they presented on the call yesterday, like the bring your own chips, in addition to the ability for customers to lease. So I think that they are very vigilant about the level of debt that they're willing to take. They have a number of other options, including issuing equity. But at the end of the day, the overall CDS level is still relatively low for a company of Oracle's size and stature, and we don't believe that is indicative of any kind of risk for them to fail to meet their commitments.
Alex, I loved your note, and I love the idea that you're sort of saying this is a tough crowd, basically. But you did reiterate outperform, but you vastly decreased your price target from $400 to $275. Is that more because the market is just not going to push up the stock in the way that you actually think could be vindicated? Do you still think 400 could be vindicated? It's just the market's not going to go there.
Yeah, I think it's 2 points. I think it's important to point out that since our last price target, the comps have compressed, the relative multiples have come down. And number two, look, we are vigilant of current performance as well. I think for the stock to work, back to some of those more lofty angles, I think you need clear evidence of meaningful outperformance on cloud revenue and the IaaS side, not in line or slightly below. And as the confidence kind of returns to seeing those investments converting to revenue at higher and higher clips, to where at this point, it looks like Oracle is going to be the fastest growing mega cap software company, and it is the cheapest mega cap software company. So as those two things start to converge, I think you could get back to those lofty highs.
Alex, what's so interesting about your coverage range is that you're a software guy. You're also looking at Adobe, and we've just had Adobe numbers, but of course Oracle has made this huge pivot into almost now infrastructure eclipsing its software revenue that it brings in now. But just taking a step back, the whole AI bubble debate and whether or not we're going to be good for productivity gains in the amount that we're currently spending, do you think that there is a bubble or that we're in a fine kind of space?
I think it's always hard to call a bubble when you're in the middle of it. We do see a tremendous amount of productivity enhancement that is happening in the industry. And I think depending on where you are and what part you're looking at, you can have a completely different picture. I think at this point, if you're an engineer or if you're a software developer, you can't imagine life without agentic coding. You can't go back to a time when you weren't using one of those tools. And the availability, the abundance of compute is increasingly leading to a renaissance of software development and code creation. I think if you're kind of a traditional knowledge worker, you're still kind of waiting to see that 10x, 100x improvement in your capabilities. And I think that's natural because those things are a little bit more nuanced depending on where you work, what your role is, how much data, how much risk your firm's willing to take. So I think it's a natural progression, and folks have to remember this is a journey. This is we are still way away from that destination, but it's an extremely exciting time to be in this space, and I do think that we are on an accelerating growth path for many of the companies that we cover.
Alex, I'm going to recap just really quickly. Capital expenditures slightly ahead, a few $1 billion of where the street thought it would be, but impressive growth in cloud. The stock, a decline of 14 to 16%. Would be, if we close this level, down the most in 23, 24 years. Is Oracle good at technology, Alex? Very quickly.
Yeah, I think Oracle's great at technology. I think Oracle, for multiple decades, has been able to make the pivot to the new, exciting secular domain. It takes time, like it did for Oracle in the cloud. I would argue that they've made the pivot to the AI compute cycle much faster. And I think over time that will serve in their favor as their ability to take their existing customers and convert those customers to both an AI cloud first and AI native world with a full stack experience, not that dissimilar from what Microsoft has done, will put them at the forefront of a lot of these secular waves.
Alex Zirkin of Wolf Research, fantastic talking to you. Thank you very much indeed on all things Oracle and beyond. Meanwhile, coming up, Disney. It agrees to invest $1 billion in OpenAI and license characters for use on Sora, on ChatGPT image. We'll dig into it next. This is Bloomberg Tech. Disney will invest $1 billion in OpenAI and license more than 200 characters for use on the Sora generative video platform and in ChatGPT images. It's all to generate short, fan-prompted videos and stills. Bloomberg News entertainment reporter Hannah Miller joins us now, along with Dave Lee from Bloomberg Opinion. And Hannah, I go to you for the news first, because this is a big step in IP licensing in the world of generative AI.
Yeah, there's been a lot of anxiety about how AI will affect the entertainment industry, and Disney's support, its investment in OpenAI is a huge development. I mean, this is something that, we didn't really expect. There's been a lot of, tension and controversy with AI in film.
Dave Lee of Bloomberg Opinion, I get what OpenAI gets out of this, a library of creature characters, 200 of them. What does Disney actually get out of it?
Well, look, I was watching an interview with Bob Iger earlier, and it struck me that he's been in this game a long time, and I think he's actually got a very good deal. I think he's gone to OpenAI and he said, your Sora app, which people are using, is only fun when you use, essentially, without deals, stolen material, IP from other companies, whether it's Disney or Nintendo or even the Premier League. And I think Bob Iger says, right, you need this. You need consumer attention. We know there's a lot of pressure from Google on OpenAI. And so what Disney gets is it gets a slice of this big, exciting AI company. They get that $1 billion investment with the chance to do more. They have a deal that is only exclusive for a year. So if we find that consumers are really into making these short videos, which I'm not too sure they will be long term, then he can shop it elsewhere and make more deals like it. And he also gets to go to Google and say, look, OpenAI have made a deal, so now you should do as well, because that's how this is going to run from now on. So I think, honestly, I think Bob Iger has shown his experience here and made a very smart deal indeed.
Hannah, the company's also disclosed that basically Disney becomes a major customer of OpenAI. What other technology work are they going to do together?
Yeah, I mean, it's great that they get to use these OpenAI tools. They will be able to give access to ChatGPT to their employees. But I think what we can see from this is just the beginning, that there could be more down the line.
What's really interesting, Dave, is we've heard in the same breath Bob Iger really confirming that he's sent a cease and desist to Google. We know that they've been litigious about their IP when it comes to Mid-Journey, when it comes to Chinese generative AI opportunities. Are we then, after this year of exclusion, just going to see a whole myriad of deals being done? And what will Hollywood and creatives think about it?
I mean, there's two sides to it, isn't there? I mean, I think, yes, there'll be deals done, or at least there'll be attempts and maybe more lawsuits instead if the deals aren't made. You will see this increased uneasiness, and we're already seeing out of Hollywood of people saying, well, what's Disney's end game here if they're going to start using OpenAI's technology? I think this is, if anything, quite a troubling development for the AI companies, because, you know, if OpenAI is going to have to give away $1 billion of its firm to all these people who want intellectual property, well, then there's not going to be enough of the company to go around. And, you know, I have to think to myself, you know, if you're someone who's backing OpenAI, you're thinking, okay, we've got Mickey Mouse, he's not allowed to talk, probably, and they're going to be short clips. Is this really getting us to super intelligence? Like, is this an important part of that? I don't see it personally. I feel quite cynical about this entire deal, I have to say. But there's a lot there that I think is troubling for AI companies looking to do some of the same things next year.
Dave, just real quick, that's what I'm trying to understand. Who has the balance of power here? Which side needs the other more? The studios in Hollywood or the AI labs?
Do you know what? I think the question is, for the studios in Hollywood, they can live without working with these AI companies, so they might as well just get as good a deal as they can get, and if they're not happy with it, they can walk away. And that's perhaps why Google was in a stronger position. It'll be interesting to see how the talks now have to, you know, carry on with Google and Disney, because OpenAI realized that they don't have any other business with Disney, so there's no incentive for Disney to sort of bend more to their will. I think in Google's case, you know, Disney just signed a new multi-year deal with YouTube TV, for example, so there's a much more sort of close meshing there between those companies. I wouldn't be surprised if some agreement came out of, you know, around Sora and Google quite soon. But yeah, I think that's where we're going to see these sort of interesting power plays. But if you're an owner of intellectual property, really good stuff, particularly, like I say, like Nintendo or football companies, I think you're in a very, very strong position.
It really is notable, though, I think, that some of these large language model developers would say, and chatbot owners are saying, we are amazed at how much people are using them for image generation. Even if it doesn't lead us to super intelligence, it's an addictive element to the use and maybe outperforms, therefore, and who wants to be using it and keeping 800 million people wanting to use it every single week. But Hannah, when the power play comes back to the worker, you reported long and hard about the strikes that happened in Hollywood. What do you think the narrative is Bob Iger needs to give to his workforce?
Yeah, he needs to give reassurance. I mean, people are worried about their jobs. Hollywood has been through a lot lately, you know, from the wildfires to layoffs at major entertainment companies. So I think there is a lot of concern here about replacement. If you're going to be able to use AI tools to animate, you know, why do you need humans behind it?
Bloomberg News reporter Hannah Miller, Bloomberg opinion contributor Dave Lee. Thank you to you both. Caro.
Yeah, what a deep dive. We've got more coming up, though, next for you on earnings. You're joined by the CEO of the chip design software maker Synopsys that recently got a big endorsement from Nvidia. That's next. This is Bloomberg Tech. We are sticking with tech earnings, and we're going to deep dive on chip design software maker Synopsys now, just out with its own fourth quarter results, giving an upbeat first quarter forecast. This following a significant equity investment from Nvidia earlier in the month that sent shares higher, and maybe we're just pairing some of the previous gains. We're just down by 1.2% on the day. Synopsys CEO Sassine Ghazi joins us now. And even though your shares are down a little bit, the analysts seem to feel positively about these numbers. But JP Morgan asks that maybe you're being slightly conservative on your full year 2026 guidance. Are you?
We're looking at it as being balanced and pragmatic regarding FY26, given the global and the overall environment. We guided at 9.6 billion, and that's after finishing up FY25 at 7 billion. So we're very excited about the opportunity ahead.
Chip design right now, there are some bigger picture discussions to be had. A great debate about companies big and small looking at custom ASICs through to doing more in-house versus not bothering. Because why? Nvidia is doing such a full stack offering. What are the trends that you're seeing, particularly when you think about your backlog, Sassine? Because the analysts are also talking about your backlog ex Ansys.
Yeah, we have a significant backlog entering FY26 at 11.5 billion. And what's driving that backlog is the strength across the portfolio. As for your question, most hyperscalers, they're looking for multiple alternatives to how to build and optimize along the stack. The silicon is an essential component, as you know. And almost every one of these hyperscalers, they have a strategy along three vectors. One, they buy merchant chips from Nvidia, AMD, Intel, etc., and they build their software stack. Then there's the custom vector, or ASIC, and they have their own customer own tooling, what it's called, where they design the chip all themselves. For Synopsys, all three vectors are a fantastic opportunity because you need the essentialness of what we provide in order to achieve that silicon design all the way up to the system.
It's the first time we've spoken to you since that $2 billion endorsement, investment in your stock coming from Nvidia. And at the same time, Nvidia is trying to gain inroads once again back into China. You've got headwinds in the China part of the business. How do you see that part of the world evolving?
So the Nvidia investment was really driven, and it's a significant endorsement to our strategy to provide engineering solutions from silicon to systems, where Nvidia has been talking about the whole physical AI, et cetera. That cannot happen without having physics simulation inside the product development, and that's what Synopsys provides. As far as the China market and opportunity, FY25, we faced a significant headwind in China. Our business declined by about 20% due to these headwinds. What we talked about in our FY26 guide is we'll continue on assuming that the environment in China will remain status quo, the same stress that we saw in 25, and we have de-risked it out of our forecast.
Sassine, very, very quickly, 30 seconds. Why does Nvidia need to have an equity stake in your company?
It's exactly what Jensen said. He sees a great opportunity to make money and to make sure that he's participating and aligning both companies' roadmap in order to accelerate the investment and deliver to this opportunity.
Synopsys CEO Sassine Ghazi, it's great to have you on Bloomberg Tech. Thank you very much. So coming up, we've got to get back to Oracle's dip and what's behind it, because that's the big driver of markets. Capital expenditures, Caro, ahead of what the street was expecting by billions, but massive growth in cloud, in particular in infrastructure. We're worried about debt. And then this is the after effect. NASDAQ 100 is down 1.2%. Mag 7 stocks feeling it. Actually, it's the chip stocks where it's probably the pain most felt, but that Oracle decline, if it closes that way, biggest drop in almost 24 years. It's Bloomberg Tech. Welcome back to Bloomberg Tech. This is a story about rising AI spending, and that spending rising at a level that is not satisfactory to investors who want to see how it will convert into growing revenues. The story is Oracle. The stock and its shares on track for their biggest drop in about 24 years. That's the story. Capital expenditures in particular, billions of dollars ahead of what the market was expecting. Let's get out with the Bloomberg Intelligence reaction. Anurag Rana joins us now. I just wanted it to linger. It's severe, and we spent all of yesterday's show saying this might happen. That's your reaction and your research. What's your thesis when you woke up this morning?
Yeah, I mean, I was surprised that they didn't talk a lot about the supply constraints because, we heard it from CoreWeave, we heard it from Microsoft and so forth. But they did spend a little bit of time trying to explain the funding issues, but it doesn't look like, the market's happy with their explanation. But, one of the big things is when their cloud infrastructure estimates were 69% growth in constant currency, and they came at 66. And anybody who's followed, what happens with Microsoft Azure or AWS numbers is, when you miss on a cloud growth rate by even a little bit, I mean, that has an impact on your stock. And that's what we are seeing here. On top of that, they talked about increasing their capex by $15 billion. That was another thing. So there are multiple factors that are affecting the stock. But having said that, you also go back and see there was one day when they announced that big OpenAI deal, the stock had gone up like 25, 30% at that point. So there's a bit of digestion in here, and it'll take a few years to figure out how much or how long will it take to take that 500 billion of backlog and convert it into sales.
Talking of that backlog, many would say that the moon music is still in their favor, maybe why the shares remain higher for the year. Anurag, I'm looking at this really in-depth survey that you've done of the C-suite over at Bloomberg Intelligence. And one of the key findings really was that all industries cite a shortage of AI infrastructure as a roadblock. So when will we know that Oracle is good for the $500 billion in backlog that they have?
Yeah, it's probably the most important questions for all of these companies right now. But you have to separate the OpenAI Oracle relationship with the rest of the hyperscalers, because the rest of the hyperscalers, if let's say God forbid things go bad next year and we don't need that much AI infrastructure, it's okay for the three hyperscalers because they have a lot of other businesses that they can run. They have their entire cloud businesses, search businesses, etc. for the three of them combined together. But for Oracle OpenAI, the big question is, OpenAI by the end of the year is going to do 20 billion of annualized revenue at somewhere in that range, and it's made commitments of hundreds of billions of dollars. So this is one pocket that needs to be examined a lot more carefully than the rest of the equation. But having said that, we are very confident from what we learned from these executives that AI infrastructure is the biggest bottleneck in deploying, all sorts of AI functionalities, in any part of whether it's hospitals, financial services, or pharmaceuticals.
Bloomberg Intelligence analyst Anurag Rana with really important research. We now want to talk about how that affects your investments. Beth Kindig is here with us, lead tech analyst at the IO Fund. And Beth, we come to you because of your semiconductor expertise, but here is Larry Ellison and others over at Oracle saying, look, we will put in whatever chip you want. We are not beholden on Nvidia, but what they do seem to be beholden on is a supply issue, not a demand issue. Is that coming down to semiconductors, or is it more the build out of data centers?
Yeah, I think it's a natural statement for Larry Ellison to say that because we know custom silicon will help drive down those CapEx costs. From my perspective, we really are at the crux of this issue to where, for example, Oracle's estimated 2026 CapEx was supposed to be $9 billion. We're now over 20 billion, low 20 billion. Assuming no more raises, we are, significantly higher, 2.5x higher than what was originally estimated. This is what one analyst has called drunken sailor type spending. However, what I would encourage investors to keep an eye on is the moment that there's an inflection. We haven't gotten that inflection yet. And that is really what these very smart tech CEOs across the board are banking on. As an investor, I need to pay attention to what these CEOs are saying. And they're talking about an incoming wave of monetization to where some of these cash flow issues really do get relieved.
So do you think the cash flow will not be negative going forward? At the moment, we're seeing, well, their capex is 75% of their full year revenue.
There will be a moment, I don't know when, I don't think it'll be 2026, maybe not even 2027, where you're able to so rapidly monetize AI that it can really absorb these CapEx costs. Now, your Bloomberg Intelligence correspondent just mentioned OpenAI. OpenAI is a great example of just how quickly this ramp can happen. It is the fastest run rate we have seen from 0 to 20 billion in all of tech's history. That is a clue as to how quickly the inflection can actually happen here.
Beth, I just want to go back to what's happening now in the market. A single session, a market does not make. But Nvidia is down almost 4%, on track for its biggest drop in 5 weeks. Just going back to Kara's original question, why? What's the anxiety that's spreading to Nvidia here?
Tonight, Broadcom will report, and there are certainly some concerns that Nvidia will start to lose market share to competitors such as, potentially merchant TPUs. Right now, they're mainly used for internal purposes. If those become commercialized, the threat is, could that eat into Nvidia's share? Now, I've surfed some concerns with the market on this stock for many, many, many years. Technically, when I first started covering this stock in 2018, 2019, TPUs were a threat actually back then, and I covered it back then. So, just in a nutshell, the AI market will widen. It will include more revenue from Broadcom, but that does not mean Nvidia's out of the picture by any means.
The messaging from Oracle, right, not beholden to Nvidia, and Kara made that point smartly. The debate with ASICs generally, like Amazon has this issue, is that there's not the library of software. That's why Nvidia is so good. That it's multi-purpose, easy to use, the software to support the stack, it exists. Is that changing with TPU, that consideration to your mind?
Yeah, the CUDA software platform is primarily very badly needed on the training side. NVIDIA has a near monopoly on training. As we move into inference, the CUDA moat matters less. But what does continue to matter, what does continue to matter is consider that we are not at a static point. NVIDIA's R&D is world-class. It will continue to iterate and improve. Just as TPUs can finally catch up, NVIDIA is already going to be on to the next generation of GPUs, which will challenge anything that's coming out of big tech.
Beth Kindig of the IO Fund. We enjoyed that. Thank you very much. For the next episode of Bloomberg Tech Europe, the show profiles ASML, Europe's most valuable company and one of the most important cogs of the global AI supply chain. Take a listen to what the company's CEO, Christophe Fouquet, had to say about AI bubble concerns.
Well, when people talk about AI bubble, I don't know exactly what they mean. And usually I say there's two ways to look at it. If you look at the industry, I don't think there is a bubble. So the impact of AI on the industry is just starting. And the impact on the industry will be positive for many, many years to come. So there is no bubble. I think that the value of AI, the industrial value of AI is extremely high. And this will be developing over time. There's no bubble because, like I say, we're just starting. Sometimes people talk about a bubble in reference to the stock market because we have seen some company getting extremely high valuation as a result of the excitement of AI. There, I think what you will see is more players coming over time. So initially, a few companies were, I would say, very much the only winner out of AI. Because of the demand, because the industrial demand will be so high, we need more players. And you will see more and more companies designing chips, designing AI product, manufacturing chips, et cetera, et cetera. And that could create, of course, some change on the stock market. But, the two are a bit unrelated.
Because that commitment, $300 billion just this year alone from the hyperscalers, maybe $400 billion next year, that translates into real orders for your kit in the years ahead. You start to see that.
Over time. And sometimes, the last few months, I used to joke with some of our investors because they told us, well, 200 billion here, 500 billion here. I say, well, I still don't have the equation to translate those orders into order for us. And it takes a bit of time. But you're right. Over time, that demand translate into cheap demand to our customer.
Yeah.
This translates into a need for more capacity, and this translates into demand for ASML and our peers in the industry.
The infrastructure spend from the hyperscalers and the kind of deal making that OpenAI has done, almost $1 trillion worth of deals committed just by that one company alone, which isn't making a profit this year. That makes sense to you?
Well, I think the investment makes sense overall because you cannot play in AI without investing in hyperscaler. And there may be even a few cycles of investment because the investment today is done on certain chips. The chips in 2-3 years from now, if you look at Nvidia announcement, they will be a lot more powerful. And people may be tempted again in 2027 to invest again in hyperscaler to make use of those chips. So you have different cycles, and you have a bit of a arms race because if you don't invest today, you're out.
That was Christophe Fouquet, CEO and President of ASML, along with Bloomberg Tech Europe host Tom McKenzie. You can find the full episode of Bloomberg Tech Europe tonight. You have to stay up a bit late, 1:30 a.m. Eastern, but 6:30 a.m. over in London time, and it'll be online. Meanwhile, coming up, we'll be joined by the CEO of Medra on how the company is trying to revolutionize drug development and other life science fields with physical AI. This is Bloomberg Tech.
Drug development and other life science fields have relied on industrial automation for decades. Startup Medra is aiming to take that a step further, building software that scientists can use to direct lab robots using natural language the way they would with a chatbot. The company's just closed a $52 million Series A funding round. There are some big names in it. Medra CEO Michelle Lee is with us in San Francisco. This is very interesting. When you and I first met a few years ago, you had an idea and a concept. Now you have a company moving forward with it. I think actually as a start, let's explain why having that degree of interaction with what is a robotic arm in that lab environment through natural language is necessary. What does it solve for?
Yeah, so we want to give scientists directly, not just engineers, but scientists directly, the ability to actually run experiments at scale. And that is why we are building the physical AI scientist, physical AI that allows them to automate their scientific experiments at scale, and also the AI scientists, so they can talk to it, they can co-pilot design experiments with this AI scientist.
What is it that you bring that others haven't in terms of the physical AI? Is it your data that's paramount to none? Is it the fact that your scientists are paramount to none? Is it the technology? What is it?
It is all of those things and more. Industrial automation has been the key way that life sciences has automated their labs, but we are seeing a huge paradigm shift across every industry that is using robotics, where industries are shifting away from industrial automation to physical AI. And that is also what Medra is bringing to life science, the ability to flexibly automate their lab experiments instead of using brittle lab automation technologies from before.
When I think about this and I review the photos and images, I hope we have some images to share with our audience. I think a little bit about Tony Stark and Jarvis. It's the idea that there is an artificial intelligence that one interacts with through the robotic mechanism. When we first spoke, and this a long time ago now, this was about like efficiency. Like labs are difficult environments. It's hard to move around them. Takes physical strength and time. To, But $52 million is a lot of money. You just click your fingers and you can suddenly do it. You've solved it.
No, I mean, we have so much more to be building because, again, it's not just about automating the work, but about this idea, can we automate science itself? Can we have a scientific AI that can reason about the science, generate hypotheses, design experiments? And when we actually run the experiments with our physical AI, once that data is generated, can we take that data and then can we think about what are the new optimizations and changes necessary to make that science better?
We started the conversation by introducing this as in the context of drug development, other life science fields. What is the industry there and therefore your customer?
Yeah, so we are working with some of the leading biopharma companies, including Genentech, to help them use our technology to really create this lab-in-the-loop idea. And we are working with some of the best machine learning teams at our customers, where their machine learning teams can then propose new experiments they want to run, new ideas they want to test. And then again, our physical AI scientists can take those ideas, those predictions, and turn that into data that then feeds back into their machine learning models.
This $52 million, where is it going to be spent most predominantly? Talent, marketing, what?
All of those, again, all of those above. We are growing our team and expanding our team across engineering, robotics, AI, hardware, software, and also on operations and go-to-market. We're expanding partnerships with other biopharma companies, and also we will be building our own lab. We'll be opening up an autonomous lab with 100 robots next year to be able to run experiments and generate data at scale.
Do you think the U.S. is leading here, Michelle?
We want to be leading, and Medra is going to be that force that helps the U.S. lead in this area.
Medra CEO Michelle Lee, great having some time with you. Congratulations on the raise. We appreciate it.
Thank you so much.
Coming up, look, there's a new lawsuit claiming that ChatGPT is liable for a murder-suicide. We'll talk about the case, the mounting legal claims against the maker of the chatbot. That's next. This is Bloomberg Tech.
A new lawsuit claims OpenAI and its largest investor, Microsoft, are liable for a Connecticut murder-suicide. It's the latest case to blame ChatGPT for dangerous psychological manipulation of users. Representatives from both companies declined to comment, and OpenAI CEO Sam Altman, who's also named in the suit, didn't reply to a request for comment which sent to OpenAI representatives on his behalf. I want to get more details with Bloomberg AI reporter Rachel Metz. Let's start with the suit. What is alleged in the suit and some of the most important details in the reporting, Rachel?
Yeah, well, this suit is alleging that this man used ChatGPT over a long period of months, and that it was consistently telling him that these delusions that he had were accurate and they were real. Delusions related to him being under surveillance, to people wanting to kill him, particularly surveillance related to his mother in the home where they were living together.
Rachel, sadly, AI psychosis is not the first time we're talking about this. It's even got a sort of technical name if you go out and look for it. But when we hear from OpenAI responding to this, saying we continue to improve ChatGPT's training to recognize and respond to signs of mental or emotional distress, to de-escalate conversations and guide people towards real-world support, are people understanding that message? Are you seeing signs that on this occasion things could have been improved through improvements in the chatbot through this case?
I mean, I guess what I would say is through the extensive reporting that I've done and work that I've done with my colleague Ellen Hewitt, we've seen a lot of stories unfold that are really similar, actually, to what we're seeing in this story. This story just happened to have a horrible, horrible outcome. So I'm not sure if the changes that they've made are really going to change how people are using the chatbot. It sounds like a lot more is going to have to be done as far as both changes and education to users in order to make a meaningful change here. But we're just going to have to see going forward. Also, there are a growing number of these court cases, and we'll have to see how all of that shakes out as well.
It's a funny thing to ask, but in the landscape of generative AI tools and chatbots, is this something that other technology companies face as well? You and I have discussed character AI, for example, in the context of people that interact with the technology, maybe for emotional support or otherwise, but that is a very specific design of a chatbot.
Yes, exactly. I mean, the OpenAI is absolutely not the only company that is facing this, either facing situations where people are saying that a powerful chatbot led to or reinforced untrue beliefs that they had. But you're also seeing this definitely stick with this idea of powerful chatbots. I think one thing that I think needs to be looked at more is, are there certain chatbots that seem more likely to lead to these kinds of situations? That isn't totally clear to me yet. If like Replica AI, for instance, is a service that is more intended for emotional connections between a person and a chatbot. But does it make a difference if a person goes into that kind of experience knowing and desiring that? I'm not sure. So it'll be interesting to see in the next few years how researchers determine what's actually going on here.
Rachel Metz, it's a thoroughly reported piece. Thank you very much indeed for telling it to us and our audience today. Meanwhile, that does it for this edition of Bloomberg Tech. Ed?
Yeah, markets are under pressure, right? And Oracle is at the heart of that story. Thought it was really interesting that Beth Kindig, one of our guests, talked about Broadcom after the bell. And like there's similar themes there. That Oracle decline of 14%. On track for its biggest drop in 23 to 24 years. That's the severity of it. We'll see where it closes. Check out the podcast. There were loads of conversations worth recapping. This is where you can find it. From New York City and San Francisco, this is Bloomberg Tech.